Hi guys, can you hear me guys?
Yep. Hello.
Hello. Okay, so let's start on tutorial. So today we'll discuss the last topic in the financial accounting. Financial accounting group in the subject. So I think this topic is quite easy compared to the other topics. Okay, so we're going to discuss how to analyze a financial statement and basically how to infer some information from the financial statement, okay, and how to use this information for any kind of business decision, okay. So whether we want to invest in a company or you want to transact with this company, at least we need to know whether they are a bona fide company financially, okay. So this kind of inference could be done from their financial performance, which is reported in the financial statement. Okay, so let's start with the definitions. A simple definition of financial statement analysis is basically an examination of company's financial health. Okay, so we want to know whether this company is performing okay in their financial performance. Okay, and then whether this company is a bona fide company for investment or transactions. Okay, and then this examination hopefully will lead to a good business decisions. Okay, so we will use this information in our business decisions. Okay, so whether in making an investment or any other business transactions. Okay, so we want to evaluate whether the company is a profitable and sustainable company for investment. Okay, so what we need in this analysis, so basically at least we need three components for this analysis. The first one, we basically need the information. Okay, so we need the financial information, we need the accounts of balance sheet accounts, and then we need the profit and loss, and also need some information from the cash flow statement. Okay, so basically we need all information about this company's financial performance. Okay, so we will take all information from their income financial statement. Okay, so we will use their balance sheet, profit and loss, cash flow statement, and even we will use the notes to financial statement. Okay, so after that we need the standard. Okay, we need standard or the benchmark. Okay, to compare with this information. Okay, so we need a benchmark or standard as our guideline to infer whether this is a good performance or bad performance, okay, or efficient or not efficient. Okay, so we need the standard or the benchmarks. So basically we can use the industry standard or industry benchmarks. Okay, their competitors, or even we can use the same company in the prior year or past performance, their past performance. Okay, so we can evaluate whether we have a growth or a decline if we compare the company's past performance with the current performance. Okay, so I think it depends on our purpose in analyzing this financial performance. We can select the most suitable standards. Okay, so let's say if we want to analyze whether this company is a good company for investment, I think we can use their industry peers performance. Okay, so if the companies perform above the peers, it means they're a good company, and if they perform under the industry peers, and then it means the company is not really good for investment. So it depends on the objective of this analysis. We can select the most appropriate benchmark or standard. Okay, so the government is, and I think some of financial companies is issuing some benchmark or standards that we can easily use. in our analysis. Okay, and lastly, we need the tools of analysis. So we need the tools that we are going to use to infer or to analyze the company's performance. Okay, so basically we will use the ratios as our tools, okay, of analysis. So today we only discuss this last part, which is the tools of analysis. Okay, so we're going to discuss how to calculate the ratios and how to interpret the ratios and how to use the interpretation in the business decision making. Okay, so at least we need these three components in our analysis. Okay, so and then next, what we need to know in the analysis, the first one, we need to know the different types of ratios and what they tell us about the business. Okay, so today we only cover three group of ratios, which is liquidity, solvency, and profitability. We still have many other ratios, okay, outside of these three groups, but we don't discuss this in this session. Okay, so we only focus on liquidity, solvency, and profitability, and we need to know the formulas. So we have to calculate these ratios correctly. That's why we need the formulas, and then we need to interpret these ratios, what these ratios means. Okay, so and then hopefully we can use this interpretation in our business decision making. Okay, so in making the interpretation, the business knowledge or industrial knowledge is really critical. Okay, so we have to have sufficient business knowledge or industrial knowledge to properly interpret what these numbers or this ratio means. Okay, so this is the step that we are going to use in analyzing the financial performance. Okay, so type of ratios, we have three types of ratios. The first one is the liquidity ratios. It's basically capture the short run or short-term liquidity of company. Okay, so it shows you the ability of this company in repaying the short-term debts, okay, or current liabilities. Okay, so how good is the company satisfying all the current liabilities using the current asset or any other asset? Okay, so this ratio is really important if you want to make only like short-term investment. Okay, so if you want to transact with this company. Okay, so we need to know their ability in at least repaying their current liabilities. Okay, so the next group is the solvency ratios. This ratio will capture the company's ability in satisfying their long run liabilities. Okay, so it gives you the a more long run picture of company's ability in repaying all their liabilities. Okay, so we focus more on non-current liabilities, okay, like loan or bonds, okay, and any other non-current liabilities. Okay, and lastly, we have profitability ratios. It simply tells you, is the company profitable? Are they able to generate profit out of their sales? Okay, so are they managing their inventories or receivables properly, so they can generate some profit from there? Okay, so this ratios basically is really important to analyze the ability of company to generate profit. Okay, so we only cover these three ratios in our sessions. Okay, so if you're interested, you can also learn many other ratios other than these three. Okay, so let's start with the first one. It's which is the liquidity. Oh, I think before that we just need to overview what ratio that we are going to use. For liquidity, we're going to use 4 ratios. It's actually 2 ratios and 2 other turnover. So for the first one, we will going to use the current ratio. It's simply current asset divided by current liabilities. We also have a quick ratio, which is more shorter picture of a current ratio. So in this quick ratio, we only compare cash and cash equivalent. with the current liabilities. Okay, so if the company have to pay all their current liabilities tomorrow or this week, are they able to do the payment using the cash? Are they have sufficient cash to do the payments? Okay, so this quick ratio will tell you the ability of quickly repaying their current liabilities. And then we have a receivable turnover. So it's so as their ability, the company's ability to manage their receivables, account receivables, and also inventory turnover. Okay, in solvency ratio, we have 3 ratios. We have debt to equity ratio, we have debt to asset ratio, and lastly, we have time interest earned. Okay, and lastly, in profitability, we have 5 ratios. So we have profit margin, return on equity, return on asset, earning per share, and price to earning ratio. I think this last one we have discussed quite often. Okay, so how the price compared to the company's fundamental financial performance. Okay. Okay, so let's start with the first group, which is the liquidity. Okay, so first we have current ratio. Okay, so current ratio is simply current asset divided by current liabilities. So total current asset divided by total current liabilities. Okay, so you can also multiply this by 100%. Okay, so basically current asset, current liability, and current liabilities is showing the company's daily operations. Okay, so we also call these two accounts as their working capital. Okay, so this, we also call this as working capital. Okay, so basically we should expect that this ratio should be bigger than 1 or 100%. Okay, so it means that the current asset is sufficient to satisfy all current liabilities. So a good company should have their current ratio is larger than 1 or at least 1. Okay, so it means they have sufficient current asset to repay all current liabilities. Okay, so a higher ratio, a higher current ratio means more liquidity. Okay, so if they have a higher current ratio, it means this company is more liquid compared to the other. Okay, that's the first one, and then next one is the quick asset ratio. So some textbooks call this ratio as a quick ratio, and other textbooks use quick asset ratio. So you don't have to worry with this term; it's have the same meaning. Okay, so you can call this quick ratio or quick asset ratio, up to you. So basically, in the quick ratio, we want to capture a more short-term picture of a current ratio. Okay, so this time we only compare the cash and cash equivalent with the total current liabilities. Okay, so the formula is cash plus short-term investment, which is easily converted into cash within short period. Account receivable, which is also easily converted into cash. Okay, so we sum these 3 and then divide by total current liabilities. Okay, so you can multiply this by 100%. The inference is the same, so we should expect that a good company should have more than 1 of quick ratio. Okay, it means that their cash is sufficient to repay all current liabilities. Okay, so they don't have a shortage in cash when they repay the current liabilities. Okay, so higher quick ratio means the company is more liquid. Okay, so yeah, we should expect that a good company should have a higher quick ratio. Okay, so this is the first 2 ratios in the liquidity group. The next one is the turnover. So the turnover is basically, it's not a ratio, okay, but only simply a comparison between two accounts. So first we have receivable turnovers. So this formula is basically showing you that how quickly or how efficient the company using their account receivable. So how quickly they collect their receivables, okay, and how quickly they generate additional sales, and then create new account receivable and collecting it. Okay, so the formula is net sales divided by the average account receivable. So this is the average, so you have to calculate the average by adding the beginning balance of account receivable plus the ending balance. Okay, so this divide by 2. Okay, and then you just use this in comparison with the net sales. Okay, so you should expect that this ratio should be more than 1. Okay, so if this ratio is more than 1, it means that the company have no uncollectible receivables. Okay, so they can properly collect all their receivables and transform the receivable into cash. Okay, but if they have less than 1, I mean their account receivable, some of their account receivable is uncollectible. Okay, so high ratio means better liquidity. So if the number get higher, more than 1, it means the company is more liquid. Okay, same idea with the inventory turnover. So in inventory turnover, we want to evaluate how quickly or how efficient the company in managing their inventory. Okay, so the formula is the cost of goods sold divided by the average inventory. Okay, so we have average, it means we have to calculate the beginning balance plus the ending balance of inventory, right? And then divide by 2. Okay, and the cost of goods sold, hopefully you still remember how to calculate this cost of goods sold is basically the beginning balance of inventory. So beginning inventory plus purchase, any purchase of inventories, and then plus transportation costs, if any. So transport costs, and then minus the ending balance. So ending inventory. Okay, so it is basically showing you the cost of the inventory that's sold to the customers. Okay, so sometimes in the question or in the final exam, they will not give you, the question will not give you the cost of goods sold, and you have to calculate the cost of goods sold by your own using this simple formula. Okay, so if this ratio is quite high, so you should expect it to be more than 1. Okay, so it means that the inventory is transferred into the cost of goods sold. It means they are being sold to the customers, and the company is making another purchase. So the cycle is very quick and efficient. Okay, and then in the end, the inventory will be reflected in the profit or in the revenue by the company. Okay, so this is the 4 ratio that we are going to use to analyze the liquidity. Any comment or questions on liquidity ratios? No? Okay, so if you want to comment or you want to ask something, just stop me, or you can type your question in the chat box. Okay, so now let's move to the next one, is the solvency ratio. So in solvency ratio, we want to know longer pictures of a company's liquidity actually. So the same idea with the liquidity, but now we want to know in the longer pictures or in business in the long run. So we focus on how the company finance their operations. Okay, so as we have discussed several times that a company have two options in financing their operation or their assets. They can use the debt financing or liquidity, or equity financing, right? They can apply for a loan or issuing a bond, or they can issue shares to the investors for cash. Okay, so the first ratio is the debt to asset ratio. It's simply comparing the total liabilities divided by total asset. Okay, so you can also multiply this by 100%. Okay, so it basically tells you the proportion of asset which is financed by the company's liabilities. Okay, so proportion of asset financed by debt financing. Okay, so a good company should use more equity, right? So a good company or a bona fide company should use more equity compared to liabilities or debt in financing their asset. So ideally, we should expect that this ratio should be smaller than 0.5 or 50%. Okay, so it means that less than half of their asset is financed by their debt or their liabilities. Okay, so but why we should prefer more equities? Because if the company use more debt, they have higher risk of insolvency. Okay, and then they have to pay more interest, okay, to the bondholders or to the financial institution because of this debt. Okay, so it's more costly for the company and also more risky. Okay, so ideally you should expect that the company use less than 50% of their assets. So the company should use less than 50% of their liability financing to finance their asset. Okay, so but other investor will see that if they have a higher proportion of that financing, it means the company is using more financial leverage. Okay, so that's another perspective of this ratio. So in the one hand, this ratio will show you the risk of a company's option in using more debt financing or liability financing. So they have a higher bankruptcy or insolvency risk. Okay, but it also shows you how effective the company used the leverage. Okay, the financial leverage. Okay, particularly from tax benefit, because if the company is paying more interest, this interest could be deductible when the company calculate the tax. Okay, so it gives them more benefit in terms of tax. Okay, so leverage from tax mostly. Okay, the next one is the debt to equity ratio. The formula is total liabilities divided by total equity. Okay, so it's basically comparing the liabilities and equities. Is basically two options available for a company in financing their asset or their business. Okay, so you can multiply this by 100%. So we should expect that this ratio should be smaller than 1, right? So because we should expect that a good company should use more equity than loan or liabilities in financing their operation. Okay, so if this ratio is less than 1, it means that the portion of equity is slightly higher than the liabilities. Okay, but if this ratio is more than 1, it means that the company use more liabilities or debt in financing their operation, which is not really good in terms of bankruptcy risk or insolvency risk. Okay, so you have to consider the risk when we select the option or the alternative in financings. So the risk is always there, but also the benefit. So yeah, I think choosing the proper balance between the risk and benefit is really critical for managers or directors in choosing the financing scheme that they want to use.
Sorry, just a quick question. So just to It's like the higher the ratio, the greater the risk. So if it was like, let's say 0.5 and then compared to 1. So with the business, that's obviously 0.5. That's the better option, right? Like,
Yep.
Okay. All right. Thank you.
Yeah. So I think if we want to elaborate more on these two aspects, so if a company having more loan or issuing more bond, actually they are more risky because they have to pay more interest in the futures. Okay, and then some bond or some loan may have some restriction or covenant in their agreement. So the company actually have to allocate some asset as a covenant or following some restriction in the bond agreement or loan agreement. So that could be burdensome for the company. But the only benefit if the company use more debt is the tax benefit. Okay, because if they deduct more interest from their profit, they're paying less tax. Okay, compared to the company that use less liabilities or less debt in financing their operations. Okay, so these two options should be considered by a company. So they have to choosing the proper balance between getting the tax benefit from these liabilities financing, and also managing the risk of bankruptcy. Okay, so I think there's a paper, if you're interested, there's a very influential paper by Modigliani and Miller trying to identify the proper balance between these two. Okay, so they have a very popular graph that's showing that this level of debt or liabilities should be the most ideal portion that selected by the company. Okay, so thank you, Sonia, for your comment. Next is the last one for solvency ratio is the time interest earned. So basically this ratio shows us the ability of the company in paying their interest. Okay, so we compare their net profit before tax and interest with the total interest expense. Okay, so we have two alternatives in calculating this ratio. First, we can start with the net profit after tax, and then we add back the interest expense and the tax to the profit. Okay, and then divide this with the interest expense. Or we just simply take the net profit before we deduct any interest and tax, and then divide by the interest expense. Okay, we also call this profit as an EBIT. Anyone know what is EBIT? EBIT is earning before interest.
Earnings before interest and tax.
Yep. So we can simply use the EBIT divided by the interest expense. Okay, so ideally the company should be able to repay the interest expense more than one. Okay, so more than one, it means the company has sufficient resources to repay the interest. Okay, so as they issue more bond or as they use more liability financing, this interest expense will get higher and higher. Okay, so this is really critical that they have sufficient resource to actually repay all the interest expense. Okay, so if we have a higher ability of this interest repayment, so it means the company is more solvent. Okay, any comment or questions on solvency? No? Okay, so the last one is the profitability. So we have 5 ratios in profitability groups. The first one is the profit margin. Okay, so it's basically the portion of profit out of company sales. Okay, so out of $1 sales, how much profit that company could make. Okay, so it shows you the operational efficiency of companies. Okay, so I think the formula is quite simple. Net profit divided by total sales times 100%. Okay, so if you get increasing ratio or increasing numbers of profit margin, it means the company is more profitable. Okay, and next one is the ROE, return on equity, is the net profit divided by the average shareholders' equity. Okay, so the net profit, same net profit as the previous one. And then we have to calculate the average shareholders' equity. So the beginning balance plus the ending balance of shareholders' equity divided by 2. Okay, and then calculate this ratio and multiply by 100%. Okay, so this ratio is showing us the return or the profit of the shareholders' investment in this company. Okay, so if we have a higher ROE, it means the company is more profitable for investment. Okay, more attractive for investment. Okay, so yeah, so the company should try to make this ratio as high as possible. Okay, so they could attract more investment. Okay, the next one is the ROA, return on asset. So the formula is net profit divided by the average total asset. Okay, so we have to calculate the average total assets, the beginning and the ending balance of total asset divided by 2. Okay, and then this ratio shows us the asset efficiency. So how efficient is the company using their asset to generate profit? Okay, so if they have higher asset efficiency, then they have more profit. Okay, so we should expect that this ratio should be high for a good company. Okay, but for a big company which have substantial amount of asset, it's really difficult to get this ratio, let's say more than 10%, because with their large amount of asset, I think having ratio 5 to 10% is good enough for a big company. Let's say like Rio Tinto or Woolworths. Okay, so I think we should expect that the ratio should be around 5 to 10%. Okay, it's already good enough for a big company. Okay, but for small companies, especially for companies which is not asset intensive, like consulting companies or services companies, this ratio should be more than 20% or 25%. Okay, because they should generate more profit using their asset. Okay, and then the next one is earning per share. So earning per share is the amount of earning or profit for each individual shares. Okay, so the formula is the net profit divided by the average number of shares. So we have to calculate the average shares by adding the beginning balance plus the ending balance divided by 2. Okay, so this ratio is basically showing you the fundamental performance, so fundamental financial performance of a company. Okay, so some portion of this EPS will be distributed to the shareholders as a dividend. Okay, so this ratio is actually an early indication of the dividend received by the shareholders. Okay, of course, not all the profit will be distributed because the company will need to retain some profit for their future investment. Okay, so but this ratio will show you the fundamental for performance or early indication of the dividend. Okay, next one is price to earning ratio. I think we have discussed this ratio quite often. So it's basically the price of the share divided by the earning per share. Okay, so as we have discussed, the share price will reflect the market perspective. So how market value this company will be reflected in the share price. Okay, so as we have discussed, if the market is efficient, the share price will reflect all information available in the market, good or bad information. Okay, and then so the market will use this information for in the supply and demand in the capital market, and the earning per share will show you the fundamental performance. Okay, so this ratio is basically show you the market perspective divided by their original or their fundamental performance. Okay, so the first thing that we can learn from this ratio is the growth, the opportunity to grow. So if the company has a higher price to earning ratio, it means the opportunity to growth is good. Okay, so it means the market have a good perception on this company. Okay, so in the future, the share price may growing. Okay, but it also show you the risk. Okay, because if they have a higher price to earning ratio, it means the discrepancy between the market perspective and their original or fundamental performance is quite high. Okay, so the share price will be more volatile, which is not really good if you want to use the share price for like short-term investment. Okay, so because the price will be more risky. Okay, so I think the rule of thumb of this price to earning ratio is around 5. Okay, so the investor will tolerate if this price to earning ratio is less. It's not ratio, it's just comparison of price and EPS. So if it's less than 5, I think it's still tolerable. So the price will be less volatile, and then it's still attractive because they still have opportunity to grow in the future. But if this ratio is become too high, like more than 10 or maybe 20, that will be more risky. It's too risky for the investors, and the share price will be very volatile. Okay, any comment on the profitability? No? Okay. So the last one, I think. Oh yeah, the last one is the DuPont analysis. So basically tell us how we get or how we end up with the return on equity formula. So basically in the return on equity, we want to evaluate 3 aspects of company's operations. So the first one's the operating efficiency. Okay, so it's basically the comparing the net profit with the sales. I think this is the profit margin. Okay, so it shows you how efficient is the company operating their business or their sales. And then next one is the asset effectiveness. How effective the company use the asset to generate more sales. Okay, so we have sales divided by total asset. And then the capital structures, which is the total asset divided by the total equity. Okay, so a portion of the asset which is financed by the equity. Okay, so we multiply these 3 components, and these sales will simply be cancelled off, right? And the total asset will also be cancelled out. So we end up with the net profit divided by the equity, which is the return on equity. Okay, so this simple formula is basically tell us many things, right? Tell us the operating efficiency, asset effectiveness, also the capital structures. Okay, so it's really important ratio for investor or shareholders, okay, in managing their investment. Okay, it's some inference that we could make from this ratio. So we have if we have a higher asset turnover, and then the company is selling more inventory, and we have the higher return on equity. If the profit margin is higher, and then the ROE also higher should be, and then the financial leverage if higher, then the ROE also should be higher. Okay, any comment or questions before we move to your homework? Okay, so the first one is exercise 11. Okay, so we have some definition of ratio, and we have to identify which ratio is matched with this definition. Okay, so the first one shows the return to each share owned by an investor. Can you guess what
Earnings
ratio
per
is?
share.
Earning per share? Yeah, that's quite easy, right? So earning per share. Earning per share is basically the net profit divided by the average equities, right? So let me write the formula again. So net profit divided by the equity or average equity. Okay, so it shows us the return or the profit for each share. Problem B measures the difference between current asset and current liabilities. I think it's quite easy. So we have current asset and current liabilities, so it should be the current ratio, right? So current ratio is current asset divided by current liabilities. Okay, next, measure the ability of company to generate profit from sales. So we have profit and sales. So this should be the what? Profit margin, right? Okay. So profit margin is the net profit divided by sales. Okay. Next, provide a measure of company's capital structure. What do you think? So something to do with the capital structure.
I got debt to assets.
Yeah, so debt to asset is basically comparing the level of debt to total asset. So a portion of total asset financed by the debt. Okay, so yeah, we can use that. So this should be debt to asset ratio. Okay, simply debt to asset ratio. Okay, the next one shows the company's ability to generate profit from its entire resource. So the company's resource is basically the asset. Okay, so it shows you how effective that the company use this asset, their asset, to generate profit. So it's basically a return on asset, right? Okay, so the net profit divided by total asset. Okay, and then next gives information as to how a company manages its inventory. So how effective the company manages inventory to generate more sales. Okay, so it's basically the inventory turnover. Okay, and next measures the company's capital structure using liabilities and equity. So liabilities and equity. So basically, we should compare these two, liabilities and equities. Okay, so this should be debt to equity ratio, right? Okay. Next is shows how effectively a company use its current equity to generate more equity. Okay, so the current equity is basically total equity that they have. Additional equity is basically could come from profit, right? So this additional equity could come from their profit. Okay, so it's basically what? The return on equity. Right, so the net profit divided by the average equity. Next, measures a company's ability to meet its obligation in a few weeks rather than many months. A few weeks is very short. Okay, so I think the idea of this question is they want to know the liquidity of company in very short term. Okay, so this one should be the quick ratio. Okay, or quick asset ratio. Okay, next shows how well a company can pay interest on debt out of current year earnings. Okay, how able they paid interest. Okay, so it's basically the times interest earned. Okay, so we're comparing the EBIT with the total interest expense. Next, measures a company's ability to collect sales on credit. Sales on credit will be captured in their receivable. Right, so this basically shows how effective the company manages their receivable. Okay, which is the account receivable turnover. Okay, and the last one provides an indication of current investor perceptions of the company. Okay, so, we have discussed that the current investor perceptions will be captured in the price, right? And then, yeah, so this ratio should use the share price, okay, which is the price earning ratio. So the price divided by the earning per share. Okay, just to give you some easy way or some hint to memorize the formula. So if we have a ratio start with a return, let's say return on asset or return on equity, in the formula we always have a net profit. Okay, because we want to analyze the return of investment or asset, which is come from the net profit. Okay, so return on asset is net profit divided by total asset. Return on equity is net profit divided by the equity. Okay, so that's one hint. And the other hint is that if we have ratio and with turnover, let's say account receivable turnover or inventory turnover, okay, typically we will have sales or cost of goods sold. Okay, so in this case, we have cost of goods sold. In the account receivable turnover, we have sales. Okay, so we don't use profit in the turnover. Any comment or questions on exercise 11? No? Okay, let's continue. The next one is exercise 13. So we have Lim Limited. We have some information from their financial statement, and we also have some ratio to calculate. So we have to calculate 5 ratios in the profitability. Okay, so the first one is the profit margin, and then return on equity, return on asset, earnings per share, and price earning ratio. Okay, so let's start with the first one is the profit margin. Okay, profit margin is a portion of profit out of a company's sales. Okay, so the formula is net profit divided by sales. So net profit is 150,000 and the sales is 945,000. Okay, you can multiply this by 100%. Okay, and then we will get the profit margin, which is 15.87%. Okay. Next one is the return on equity. Okay, as we have discussed, if we have a return, then we always have a net profit. So return on equity is the net profit divided by the average equity. So 150,000 of net profit divided by the equity. So we have this equity. So the beginning balance should be 450. So this will be the beginning balance, and the ending balance is 475,000. So 450,000 plus 475,000 divided by 2. Okay, and then multiply by 100%. Look at this return on equity, which is 32 something, 32.43%. Okay. Next is return on asset. So we have the net profit divided by the average of total asset. So 150,000 divided by assets. Asset is this one. So we have the beginning balance is 800 and the ending balance is 1 million. Okay, so 800,000 plus 1 million divided by 2 times 100%. Okay, so we get 16.67%. Okay, and the next one is earning per share. So EPS is the net profit divided by the average number of shares. We have this number of shares. So the beginning balance is 400,000, the ending is 500,000. Okay, so 400,000 plus 400,000 divided by 2. EPS is not a ratio, so you don't have to you multiply this with 100%. Okay, so we'll get 0.33. Okay, the last one is price earning ratio. So price earning ratio is the share price, which is price is this one, 10. Okay, so 10 divided by the EPS, which is 0.33. Okay, this should be 30. So 30 point something, 30.3. Okay, okay, so this is the ratios of profitability of LIM Limited. Now we need to interpret this ratio. Okay, so let's start with the profit margin. So this company is able to generate 15%, almost 16% of profit out of their sales. Okay, so what do you think? Is it good enough?
I said it was low.
Quite low? Yeah, a little bit low, right? So it's still a profit. So they're able to generate profit. So it's a good sign. It's a positive performance. So it means the company is still profitable. But agree with Liam that this is a bit low for a small company. I think this is a small company, right? So companies should, I think it means that the efficiency of their operation is not really good. So if you remember how we calculate the net profit, it's basically the sales minus the cost of goods sold and operating expenses. Okay, so their operating expenses or their cost of goods sold is not really efficient. Okay, so yeah, this is rather low for this company. Okay, so they need to improve the efficiency in cost of goods sold and operating expenses to make this profit. Profit margin is slightly higher. Okay, the next one is the return on equity. So the company could provide 32% of return on equity. It's really high, right? And then it means that investment in this company is very profitable. You can get 32% of return, which is really high. So I don't think you can find, in reality, in the stock market, it's really difficult to find a company which provide this level of return on equity. Okay, so it's good in the sense that this company is really attractive for investment. Okay, but rather doesn't make sense if we compare this with the actual with the reality in the capital market. Okay, but it's good that they have a very high return on equity, and return on asset is also quite high. 16% is good and quite high for return on asset, but I think this is a small company, right? So I think for small companies it's quite normal. So yeah, so it means the company is profitable and attractive for investment. For a big company, in reality, it's really difficult to get more than 10% of return on asset. Okay, because they have a huge amount of asset, and then yeah, so it's really difficult to operate asset efficiently in the business. Okay, what about the earning per share? So earning per share is 0.33. So still the company is able to distribute the dividend in the future because each share is allocated, I think, around this numbers 0.33. So it's still profitable for each shareholders. Okay, and then we cannot infer whether this is good or bad because we don't have the benchmark. Okay, so in order to infer whether this is an ideal earning per share or no, we need to use the benchmark. We have to decide our benchmark first, whether we are going to use the industry standard or the company's past performance, okay, or even the government standard, okay, in order to infer something from this earning per share. But actually this is still okay because the company is still able to distribute a profit for each share, even though it's less than $1 per share. And lastly, the price earning ratio. If you look at this ratio, is 30, is really high. Okay, so it means that the market have a very good perspective on this company, but actually they only able to distribute this certain level of profit. So actually their original performance or their fundamental performance is only up to this level, but the market value this company up to this level. Okay, so you can see that the discrepancy is really high. So if you look at this amount, this price earning ratio, so this company have a good prospect in the future. So their opportunity to growth is good. Okay, but also the price will be very volatile. Okay, so because the risk is quite high. Okay, it depends on your investment priority, but if you just like a short-term investment, I think it's better to avoid this. A company which has this level of price earning ratio. Okay, unless you are like institutional investors and want to use this company as a long-term investment, then maybe it's okay to invest in this company. Okay, but this level of price earning ratio is quite alarming for common investors. Okay, so you should expect a lower price earning ratio in the future. Okay, any comment or question on exercise 13? No? Okay, so let's move to the next one. Is the liquidity ratios. Okay, now we have two companies, Kanner and Olson. Okay, and then we have to compare these two companies' ratios. We have 4 liquidity ratios, which is the account receivable turnover ratio, inventory turnover, current ratio, and quick ratio. Okay, and then in the end, we have to decide which company is more liquid. Okay, based on these 4 ratios. Okay, so I have calculated the ratio to make it easier. So receivable turnover is net sales divided by the average account receivable. For Connor, I got 2.13, and Olson got 1.4. Okay, so we can see that Connor is having more ability to manage their account receivable, okay, compared to Olson. Next is the inventory turnover. It's the cost of goods sold divided by the average inventory. So for Connor, I got 5.75, and for Olson it's 7. So in terms of managing the inventories, it seems that Olson is more efficient. Okay, so they have a good process in purchasing the inventory, selling the inventory to customers, okay, and making another purchase. Okay, next is the current ratio. Current asset divided by current liabilities. For Kanner, I got 67%. This is quite alarming because we have discussed that you should expect this ratio at least is 1. Okay, and then ideally it's more than 1, right? Because it's showing that the current asset is at least equal with the current liabilities. So the company can satisfy all current asset using current liabilities using current asset. But Kanner only have 67% of current ratio. It means they need some current financing. They need some short-term financing immediately. Okay, otherwise they cannot be able to pay the current liabilities. Okay, but Olson is okay. I think 1.93. So they have sufficient current asset to satisfy current liabilities. Okay. Next one is the quick ratio. So we compare the cash and cash equivalent with the current liabilities. So this is, I think this is the cash. Okay, and then this one is the account receivable. Okay, so the cash plus account receivable divided by current liabilities. For Kanner, I got 47%, which is another alarming ratio because they only able to pay 47% of current liabilities using their cash. Okay, it means they don't have sufficient cash to satisfy their current liabilities. Okay, but for Olson, I got 1.79, which is okay. So the company have sufficient cash and cash equivalent to repay all the current liabilities. Okay, so from these ratios, I think we can easily infer that or easily conclude that Olson is more liquid. Okay, so which business is more liquid? I think we can conclude that Olson is more liquid because Olson have a better ability in managing inventories and then have a higher quick current ratio and quick ratio. So they have sufficient cash and sufficient current asset to repay all the liabilities. Okay, but Connor only perform much better in managing the inventories. So if you found this kind of inconsistency, okay, so you have to look closer what happened with this ratio, why this is inconsistent with the other ratios. Okay, so we have problem with the receivable turnover, which basically net sales divided by the average account receivable. Okay, so if we go back to the questions, I think for sales we cannot do anything. Sales is given, but if you look at the account receivable of Kanner, so initially the company have 186,000 in the beginning of the accounting years, and in the end of accounting year they have only 8,000. So they can like minimize or make this account receivable is substantially smaller than the previous one. Okay, so you can see that a significant reduction on their account receivable. Okay, so for general readers of financial statement, they can easily assume, oh, they are collecting their receivables, so it is good. Okay, so they're collecting their receivables from the customers and transforming this amount of reduction into cash. Okay, so some people may say this is a good sign of company's operation, but if we assume that the company is collecting this receivable and transforming it into cash, we should see increase. We should see an increase in the company's cash balance, right? But if you look at this Kanner's cash balance from the beginning to the end of the accounting years, actually the cash balance is declining, not increasing. Okay, so this is inconsistent with their reduction of receivable. So what happened with the receivable? So they're not collecting it. They're not collecting the receivable from the customers. That's why they don't have an increase in cash. Okay, so what happened then? What happened with these receivables? Why they are substantially reduced compared to the balance in the beginning of the years? So it seems that the company is writing off the receivable. So they write off a major or substantial amount of their receivables. Okay, why they write off their receivables? Because they are no longer able to collect these receivables. Okay, because the receivable is uncollectible, so they write off this substantial amount of the receivables. Okay, so basically they make this journal entry. So in the debit they will have allowance for bad debt. Okay, and in the credit they will have account receivable. Okay, so they make this journal entry and the receivables will be substantially reduced. Okay, so they are actually they are writing off the receivable instead of collecting it. So it means it's not really good performance. It's not really good sign of their ability in managing their receivables. Okay, so yeah, I think we should conclude that even though the receivable turnover of Kanner is slightly higher than Awesome, we should conclude that Awesome is much better. Okay, because you can see that Awesome have an increase in their cash balance. Okay, so actually they have additional cash from their customers. Okay, this is one of a good example. If you found an inconsistency in your ratios, so you have to investigate in more detail what happened with this ratio, and then whether we can consider some specific circumstances of this ratio that may affect our overall conclusions. So this is a good example that the way of company could make their financial statement look bona fide. Okay, one way of earning management. So if the customer only look at the account receivable turnover, they may misleadingly conclude that, oh, this company is performing okay in their account receivable collection compared to other company. Okay, but actually the company only simply writing off their account receivable, which is not good because they are not able to collect the receivables. Okay. Any comment on exercise 14? No? Okay, so the last one is exercise 17. Now we have Emily's editors. We have some information from their balance sheet and also from their profit and loss. We have the asset, liabilities, equities, and then we have revenue, gross profit, and some expenses. Okay, and then now we have to calculate the solvency ratios, which is debt to asset ratio, debt to equity, equity to asset, and time interest earned. And then we have to discuss the solvency of this company. And then does this company rely more on equity or debt? And what is the relation of the first three ratios? So I have calculated this ratio as well. The first one, debt to asset ratio, is total liabilities divided by total asset. It's basically the portion of liabilities, portion of asset financed by liability financing. So I found 26% of the company's asset is financed through the liability financing, which is good because the company use more equity, okay, in financing their asset or their operations. Okay, and then next, debt to equity. I think ideally we should expect this should be less than 1, right? So less than 100%. Sorry, not 1, 50. And debt to equity, I found 36%, so it's also good. So it means the portion of their liabilities only 36% of their equities. Okay, ideally we should expect this more than 1. Sorry, less than 1. Okay, this company is good because they have more equities compared to liabilities. And then equity to asset. So total equity divided by total asset is basically portion of asset which is financed using equity financing. So I found 74%, which is good because the company use more equity compared to liabilities in financing their asset operations. Okay, so we should expect this more than 50%. Okay, and lastly, time interest earned is basically the EBIT, or we can manually calculate the total comprehensive. If you use comprehensive income, total comprehensive income plus total tax expense plus interest expense, 62,000 plus 25,000 plus 10,000 divided by interest expense is 10,000. Or net profit, if you use net profit before interest and tax, 85,000 divided by 10. So either way is okay, it's correct. So it's show us the same inference that the company have sufficient resources or sufficient profit to repay the interest. Okay, so in overall, I think this company is very solvent. Okay, so the company in overall is very solvent because they use more equities compared to liabilities, and they have sufficient resources to repay their interest. Okay, so I think it's very solvent. And whether they rely more on equities or liabilities, I think we can see from the ratio that they rely more on equities in financing their operation, which is good. Okay, because they have they will have less interest expense in the future, and they also have less risk of bankruptcy or insolvency. And see, what does these three ratios mean, or this ratio relate each other? If you remember that we have this formula in the balance sheet, so asset is equal with liabilities plus equities. So basically, these three ratio is showing you the proportion of this liabilities and equities in financing the total asset. Okay, so from this ratio, we can see that the company is using 26% of debt financing or liability financing, and they use 74% of equity financing. Okay, so debt to asset is basically showing you the portion of this liability financing in financing the company's operation, and equity to asset is basically showing you a portion of equity financing in financing the company's asset. Okay, and lastly, we have the comparison of these two, the comparison of liabilities and equities, which is the debt to equity ratio, which is debt to equity ratio, showing you the comparison between liabilities and equities in this balance sheet equation. Okay, so we can easily relate these three ratio using the balance sheet equations. Okay, so it's basically showing you the capital structures and also the company's preference in financing their operation. Okay, any comment or questions on exercise 17? No? Okay, the next one, the last one, I think, is the class discussion questions. Okay, so the question is, financial ratios are just numbers. They do not tell you what's really going on in the organization. You agree with this? Do you agree with the statement that financial ratio is just numbers?
I said no.
No?
Because you kind of need both. You can't just go off one to sort of get an accurate picture.
Mm-hmm. So you also need the other thing, which is the interpretation, right? Interpretation of these numbers in order to infer something, or you want to make any business decisions using these numbers. So you have to properly interpret these numbers. Okay, so I think I'm kind of agree with this statement, because financial ratio is this number. Yes, they are numbers. So they will mean nothing if we don't properly interpret the numbers. Right? If we don't give them a context, or we don't have a benchmark to compare it, so it means nothing. Okay, so the numbers is a start, it's a beginning, and then after that we need to interpret. So are they tell you what's really going on in organization? If we don't properly interpret, they don't tell us anything but the organization. But if we give this number a context and using proper benchmark, then we can learn something from the numbers. Okay, and we can infer something from this number. Okay, we infer something about organization's performance. Okay, as we have discussed in the beginning, so financial analysis is just a beginning. So calculating the ratios and then collecting information from the financial statement is a beginning. Once we finish calculating the ratios and then collecting information, then we have to use our business knowledge to interpret what these ratios, what these numbers means. Okay, first we have to select the proper benchmark or standards. Okay, so we can use the government standard or the industry standard, the competitors' performance, peer performance, or even we can use the company's past performance. Okay, and then we give these numbers a context, and then we can start interpret what these numbers means. Okay, so in the end, we can use this information, or we can also combine the information with our knowledge, previous knowledge of the company's operation in our business decisions making. Okay, so financial statement and financial ratio is not a standalone process. Okay, so we should start with the ratios, and then we should interpret the ratio using our business knowledge. Okay, in order to make a good business decision. Okay, and then avoid to only rely on one ratios, because so we have learned that each ratio is really simple. They only compare two account or two aspects of company's operations. So in order to make a good business decisions, we should use more than one ratio. So it will give you a more comprehensive perspective of company's operation. So use at least like 2 or 3 ratios in conjunction if you want to analyze certain aspect of company's operations. Okay, so and once again, if you found a ratio which is not consistent with the other ratios, then you should like a symptom that something's not normal in that ratio. So you have to look more detail and learn what is really happening with this ratio. Okay, that's pretty much everything from this topic. Any comment or question before we finish? Comment or questions? No? Okay, so I think we can finish the tutorial. So I didn't check this week's homework, but I have checked the last week's homework, the cash flow statement. So I will inform you the homework marks maybe later today. Okay, so I'll email you the marks and you can have a look. Okay, so thank you very much. I'll see you next week. Okay, I'll make the video and slide available as soon as possible.
Thank you.
Thank you.
And I was just wondering, is that possible? Because sometimes with my internet, it's like really slow to just get the recordings of like everything. Is it possible for you to send, when you send the recordings, like the actual PowerPoints as well? Okay, so I mean the PowerPoint without any annotation? Yeah, so like as I said, like sometimes my internet's so it's trying to like download the whole thing, like it won't download. So I was wondering if it's possible for like all of the ones in the past and even now, like you just send the PowerPoints too, so I can have like access when I don't have the most stable internet. Okay. Thank you so much. Okay, thank you. See you. Bye. Thank you. Bye.